Hey, good morning, everybody. It's Hammer. Today is Wednesday, March 4th, 2026. I, of course, am Hammer from Hammer Solutions, founder of Originator Success, Grab and Go Social, and Rate Sensei. Three great products to help you build your business, get more loans in 2026. Be sure to go check those out. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting on Facebook and YouTube, talking about what's going on in the markets today, what's driving mortgage rates and pricing, all that good stuff. If you're here this morning, say good morning. If you're watching the replay, don't forget to give me hashtag replay in the comments. Today, we're going to be talking about oil prices because that's the big thing right now. That is what's driving rates. We're going to talk about tariffs. They're supposed to go into effect this week and jumping up to 15%. We'll talk about if that's going to have any effect on rates. Fed members speaking out and answer the question, are people staying in their homes longer? In fact, according to Redfin, they're saying 12 years. I want to hear your opinion on that one. So we got a lot to be covering this morning. Again, if you're here this morning, say good morning. If you would like a reminder that we're going live each morning so you don't miss any of the show, go ahead and sign up at hmmr.io/reminder. It's absolutely free. We don't sell your information or use it for any nefarious purpose. I don't drunk text you in the middle of the night because I'm old and I sleep. So there's nothing to lose. Sign up, get a reminder that I'm going live each day so you don't miss any of the show. You can also use the cool QR code. There it is over on this side of the screen if you would like to be reminded that I'm going live. Also, never a bad idea to get the written email that comes to your inbox each and every weekday morning, www.ratelockadvice.com. We send out an email each morning with some advice, kind of a bridged version of what I'm talking about here on the live. And yesterday was a great example of why you need to be signed up for our text alerts. Right after the live, the outlook started to shift, and we warned our users not to lock, even though I had been in a locking stance. We told them not to lock and wait, and we saw about 30 reprices better yesterday. So make sure you consider signing up. Listen, you don't have to spend $100 a month to be for these services. $7 a month. We keep you posted on all that. So there you go. If you're here this morning, say good morning. Say hi to all the live folks. Real quick, Ron Siegel said, I jumped the gun. My reminders come in after I started and after the 30-second countdown. Siegel, I hit the button and I go. You know, the more people that sign up, the longer it takes for that text to go out. I'm sorry to tell you, man. It's a popular thing. So I'll try to do it a minute or two early. But if I do it beforehand, what happens is people go and they start watching yesterday's. I've had that happen. That's why I do that. Good morning, Scott Blake, Mike Tebow, Patrick Campbell, Randy Tico. Giddy up, sir. Debbie Richards and Jared Vincent. Great to have all of you here. So glad to have you. Let's go ahead and jump in and get started. We're going to go ahead and take a look at the technicals is where we will begin. Let me pull that up on the screen. We're going to take a look here at the technicals. Let's take a look right now. Mortgage-backed securities currently up 9 basis points. We've got some green that can give us a nice big smiley face because we love seeing green. That is a great thing to see. And the reason we are seeing green is because oil prices are doing pretty well right now. You can see that they have started to come down. I'm going to use green on this, even though it's a little harder to see because that is good. Oil price is $74.17 right now. If we take a look before all of the Iran conflict situation, we were basically right here around 66, right? 65, 66. That was kind of where we were here. And now we're up to 74. But this shows an increase, a constant increase. But what it really isn't taking into effect properly is right here. The fact that we have seen it drifting back down and coming back down from the high point here where we were at. And it's kind of stabilized. So I don't love this chart because it makes it look like it continues to go up. But I mean, it went from 74.56, 76.50, 71 to 74. The big jump, of course, was over the weekend. So that's what we've got going on this morning. Taking a look here. So quick recap, bonds improved yesterday. So when we do the live, it was right here, the lowest point of the day, as you could see. And almost right after that at 10 a.m., we just saw bonds really, really improve. Generally, lenders were coming out with pricing right about here. So depending on early pricers, they were, much quicker to reprice when things got up here because it was much better on the day. So we saw about 30 reprices yesterday. Maybe even a couple more. And most of that was due to the fact that, once again, that we had a nice increase through the day. A lot of, it's still choppy, still choppy. You can see that here. It's down, it's up, it's flat, up, then back down a little bit. But again, when we did the live, the outlook was not good because if you remember, if we do the 5-day chart here, we had big drops in overnight trading, big drop in overnight trading. And let me pull this over a little bit so that you guys can see that better. There you go. So we had a big drop in overnight trading, big drop in overnight trading, and we were continuing to drift lower right here. So when we did the live yesterday, it really didn't look good, but we saw so much improvement going on. And I'm going to pull these on the side screen before I show them. Let me move that over. You guys don't need to be looking at all my text messages, but if we take a look here and I'll pull this over, there you go. You could see that yesterday, we started out with, hey, let's cautiously float to start, is what I said on the texts. And then we had an update at 12 o'clock saying not to lock anything, that things were, improving. And then we were at the end of the day. So where we ended the day yesterday, bonds improved in fits and starts from 10 a.m. when lenders started pricing until 2 p.m. and then fell a bit to give back some of the gains, basically tracking with oil prices. And that's what we saw happening yesterday. All these gains that you see, all this movement was very much in lockstep with what was going on with oil pricing. And when you see these movements, unfortunately, I don't have an oil chart to show the range for you just yesterday, but when you saw that movement, it corresponded very much with the improvement that we saw in mortgage bonds. They were going in lockstep with oil pricing. So quite a bit of that yesterday. And then to finish the wrap up here, saw about 30-year prices better with those lenders showing rates now just slightly worse than yesterday. And I mean, it's amazing. We would have been up about 1/8 of a point. If we priced early in the morning, you were at like 6 1/4 instead of 6 1/8. And instead it went from 6.12 to 6.13. So what a big difference yesterday after the live. And that's why the text alerts, and I'll throw the text, here you go. I'll throw this up on the bottom of the screen. Everybody should have something. If you're not subscribed to the other services, make sure you sign up for our text alerts. Especially, we get very complacent that things have been so stable, and then things get nuts after that. So it's important to know that. Robert said, I'd just be happy if we can get back to the pricing we were seeing on Friday. We're not going to be there yet, but it will come back. It will come back. So we'll go into some more detail on that. Randy Tico said $7 is a true bargain. Appreciate you, sir. Robert Bashir said, I'll be happy if we can get back to the pricing we were at on Friday. Ron Siegel pointed out mixed messages on ADP. I'll come back to that one, Ron. Let's go. So to stay on track here for where I'm at, let me go ahead and show you. So rate sheets today are going to be a little bit better than what we saw yesterday for some lenders. It's going to still be right around the same range. When you look at where mortgage-backed securities are compared to where we were, again, on Friday, we were at 100.50. So for Robert, we want to see getting back up near that level. And then on Monday, we dropped down to 100.13. It was about a 37 basis point loss. Yesterday started out with an open at 99.88, which was another huge loss. Still down on the day, 100.13 compared to 99.97. Today up to about 100.7. We're climbing back. If these gains can hold, if the momentum continues this way. And a lot of what's going to affect this is basically what's going on in the headlines. As far as today goes, though, reprice risk on the day is moderate. There's still a chance for higher than normal movement. We could see these gains disappear today. It's only up 6 basis points. We could be down 15 or 20 basis points, depending on what happens with oil pricing, any headlines about Iran. So right now, the 10-year treasury back up at around 4.08. It was at 4.06 yesterday. So keep an eye on that, because this does not necessarily set us up for a better day. We ended the day yesterday 4.07. Now we're currently at 4.065. Let me refresh that, because we're not at 4.065. There you go. So we're at 4.8. 4.08, and you can see that here that now it's a 4.078. So yeah, so you can see kind of where we're at here. The 10-year treasury yield, what's going on with that. Mortgage-backed securities, though, are bouncing up. I'm not too worried about technicals when we look at like the 50-day moving average at 100.03. Arguably, this would be acting as, let me pull this over a little bit so you guys can get a clear picture of that. There you go. So arguably, this 50-day moving average would act as a technical resistance level after breaking through it yesterday. But the technicals are not necessarily taking the front line today. It's going to be about the headlines and where we're at on things. So let's go a little bit more and let's talk a little bit about the headlines and look at what things are at and kind of where we're at with these things. So first things first, let me adjust the screen so we can get all of it onto, there you go. Okay, let me get rid of this. Boom. All right, so there's definitely going to be some concerns about who succeeds in Iran and what takes over. So right now, Khamenei's Ayatollah Khamenei's son is expected to succeed him. The reason that I'm talking about this is this kind of plays into how long this whole thing could last and which direction it could go. When we look at Bloomberg, Trump has not given any insight that he's looking to control a regime change. He's even said that we could see somebody that's worse take over. It's funny when I make the window small, then everything changes place here. So I have to look and see where Trump lashes out to Spain. No. So anyway, it's through in here somewhere. But Trump said, hey, so whoever takes over next could be even worse. And so he hasn't given any insight that we will stick around long enough to make it a regime change, which could continue to control things. Right now, the big thing is what's going on with the Strait of Hormuz. And again, I know a lot of people focus on the fact that the U.S. does not get oil from Iran, but the Asian markets go nuts. That's where all of this is going on. So it does affect everything. It is a global market. Take a look here. As long as we see oil prices that are below $75, that's going to help us to see some stability in rates and pricing. If you were to see this push up to $80, or above, that's you're going to see rates jump. You're going to see bonds lose ground on that almost immediately. So you could be tracking the price of oil right now. As that works its way down, you're going to see improvement in bonds. We're seeing it. It's almost a 1-to-1 on this right now. Jumping subjects, though, looking at what else we got. Bessent says that Trump is going to hike the tariffs. I think they're currently 10%. He's going to hike them to 15%, likely this week. I don't think that this is going to shake anything up. We had different tariffs set up already with different places, but I don't think that this is going to, worry anybody about added inflation. The tariffs were already in place. These blanket tariffs are taking the place of the other act that was used for the tariffs that Donald Trump had used. So when SCOTUS struck down the validity and the ability of Trump to use that particular emergency use for him controlling the tariffs without Congress, they just implemented a different one. And this is the answer to that. I don't think markets are going to be spooked by this at all. I don't think there's much to worry about here. Quick takeaways here. Treasury Secretary Scott Bessent said President Donald Trump's plan to increase the 10% universal tariff up to 15% will likely be done this week. Bessent noted the authority for the new duties only allows the measure to last 150 days, during which time the U.S. trade authorities will look at using other legislation to resurrect the previous tariff regime, the different individualized tariffs. Bessent played down the risk to the oil market from the U.S. and Israeli war against Iran, saying that there are ample global supply and that Trump administration will be taking steps to support the sector. A big part of that is, like we said, no, hold on, I'm looking for, nope. We'll come back to that one. So it was here about the main headlines about Trump. He's committed to where the U.S. will help provide insurance for ships to get through the Strait of Hormuz, and where we're going to work to keep it open. And that could help keep oil prices low, and that would help keep rates stable. So you're going to want to keep an eye on that. If there's concern or if there's like an oil tanker were to get blown up or something, that would be tremendously bad, and we would see rates react to that. So that's your potential for volatility here. These are things that we can't control that would cause the volatility, similar to what we saw here yesterday, but it would be in reverse, where we saw all of this start off low and then move all around through the day. So keep that in mind. As far as comments, let's see. Siegel said Trump said yesterday he was halting trade with Spain. Yeah, I don't think the markets are moved too much by that. So no Spanish olives. That's an inside. That's a joke. Like that's not it. Ron, does the Ayatollah successor get hazard pay? The last replacement only lived 6 hours. Yeah, I'm sure he'll take a lot more precautions. OBMMI showing locks at 6.02 yesterday. Yeah, I have that right here. Let me pull that up and let's just do 30-year conforming. So they were showing locks at 6.022. I follow the numbers because they're actual locks and they have 35% of the market share. Yeah, the only problem with this is there's no points. It's like the Freddie Mac survey. We don't know what people were paying to get 6.022. It could be 6.022 and a half a point average. Could be a full point average. We don't know really on rate sheets, but you can see, what this screams to me is that people were locking at 5.9 on Friday and they were trying to, maybe charging some rebate, but there's not a lot of difference in rate here. Maybe there was a difference in rebate pricing. And you see more of that. But on Monday, 5.97 and then 6.02. So we could see this move back down. Again, Bashir said, hey, I want to see things get back to where we were on Friday. That was a 5.9. We will see that, but just not for a little while yet. We need to see oil prices continue to drop down. As oil prices come back down, if they get back around 65 for Brent crude, that's going to help open the door for that. Now, the rising oil prices have leaked into all kinds of things, including, I'll come back to that one. Here you go. So Feds William and Kashkari point to new uncertainty from the Iran war. When we looked at Fed futures, though, there was no expectation of a Fed rate cut at this meeting in March. That has not changed. The April one has gotten a little bit higher. In other words, less of a chance of seeing a rate cut. It's down to less than 15% expectation of seeing a rate cut, this column here. And if we compare that to, a while back, a month ago, it was 22%. And what this chart doesn't show, if we use the historical chart, it's kind of confusing to see this one, but there was a lot more of a chance, in kind of some windows. June, that has improved again. It's back to about a 60%. That was, let's see, because it moves from matching the day before. That's actually hasn't improved. It's gotten worse according to this. So maybe I'm wrong. Maybe we're there. So yesterday it was about a 40% chance of a rate cut. So that's still about there. So for June, but the end of the year, if we look at by January, remember, that's actually gotten even a little bit worse, I believe. So yeah. So if you take a look, kind of a week ago, expectations 20% that we would see one rate cut. Now about 30% that we would only see one rate cut. So that's what you're seeing here. And that is what these guys are talking about. Two Fed Reserve officials said the U.S. Israel attacks on Iran had introduced another element of uncertainty. And so let's see. Right now, it's just too soon to know what imprint this is on inflation and for how long, says Kashkari. He previously penciled in 1/4 point interest rate cut in his outlook for the year. He always tends to be a little bit hawkish. Said he was no longer as confident about that. Now with the geopolitical events, we need to get a lot more data in. So he's thinking we may not see one at all. John Williams, New York Fed President John Williams, speaking at a separate event, noted the impact was so far reasonably muted and that oil prices had moved up, but not yet in a dramatic way. And I think that's a pretty fair assessment. Again, looking at going from the 65, 66 area to 76, there was speculation that oil could go above $100 a barrel, and that would have driven rates to be absolutely nuts. And we're not seeing that. So as far as the ADP, Ron pointed out that it is a mixed message from the ADP. And what will that mean for Friday's BLS jobs data? January was even worse than they initially reported. Interesting in light of the BS from the BLS on their January. So according to this, let's go take a look together. This is the ADP private payroll data that comes out once a month. And remember, they're doing a weekly one too now. Added 63,000. I think they were expecting about 40,000. Called for 50,000, so about 50,000. So that I'm not getting where I need to be here. Here you go. So that shows that there were more jobs created. This is not labor market weakness, but as Ron points out, there's definitely things that you can look for in the data there to kind of get a better idea. Fed Reserve officials generally see the job market as stabilizing, which does not support rate cuts and does not support better mortgage rates. If the job, remember, the labor market is a big driver. If the labor market is weak, then rates generally can improve. We're not going to see a lot of improvement as long as we see a strong labor market. If we see a strong labor market, the economy stays strong, people are out spending money. That's kind of everything that goes along with it. And that's why you'll see this. So it's really, we'll see if what we get on Friday changes that outlook. Now, as of the beginning of the week, what we were getting on Friday was not looking important at all. That is now changing a little bit. It looks like, Friday's data, if we see stability like we're starting to see now, if we see mortgage bonds kind of holding steady up in this range, Friday's data is going to have a little bit more of an effect than it would have had if oil were to continue rising and things were going nuts. So, but it all depends on what happens over in Iran and in the Middle East. And that. So last thing I wanted to see with you guys, this was an interesting article. Homeowners stay put now for 12 years. Remember, I think it used to be 7, right? Tell me in the comments if you guys remember it. Don't they say that most people move every 7 years? Homeowners stay put for 12 years, stifling. I love the adjectives. Do they use ChatGPT? Stifling the U.S. Housing market. American homeowners are staying put, helping drive home prices out of reach for many, with the typical homeowner staying in their home for 12 years as of December. High costs associated with borrowing and moving, such as accumulated wealth in their existing homes, are keeping owners in place, with a lack of available housing driving prices to record highs. Homeowners are locked into low mortgage rates, have little motivation to sell, perpetuating a cycle that they're still leaning on this, but according to Logan Mohtashami, more people have 6% than have 3% when it comes to mortgage rates. So you have to wonder about the truth on that one. Deb Dixon said, yes, it used to be 7. So Randy Tickle asked hold on, let me get to that. Thank you, Deb. Appreciate the validation on that one. Randy said, so other than oil prices, what other effects does the Iran conflict have on the market movers for us? Arguably, there'd be a flight to safety, but we've noticed there's been less and less of that. Money was moved more into gold. Didn't see as much of the safe haven trades in treasuries. Generally, there's everything stems off of oil prices and the cost of moving goods around the world. So that's why it's inflationary. Remember, it's not just how much we pay at the pump and seeing a move there, but it's what effect it has moving everything around the world, fuel for other countries and shipping and everything else. So that's why all that plays a role. So the Iran conflict itself, once the oil component is taken out of it, there's not a lot that I see really. Maybe someone else can point out to me and I'll get it a little bit more. But Ron said he guesses Kashkari is making Stifle It, Edith. Yeah, I remember, Randy. NAR showing significantly lower number of tenure in homes. You pick which number you want to use. Yeah, exactly. So that was according to NAR. Yeah, Kashkari is making future assumptions instead of being data dependent, as they all should be. We know that, and they don't. So, yeah, I think this is Redfin data, is where this came from here. Yeah, so a new report from brokerage Redfin. You have to wonder if there's any ulterior motive to when they come up with some of these things. It's almost like the BLS numbers that they make it up, right? So, but anyway, just an interesting one we're talking about for here. And what we could do. So, all right, my friends. Well, I think that about sums it up. Hopefully you get the gist there. As far as locking or floating, I probably should have put this on the screen sooner. Cautiously float. Let me save this and throw it on the bottom. There it is. So cautiously float all loans for now. We want to see if we continue to get some improvement in mortgage-backed securities, see how oil prices do. At the end of the day, today we're up 7 basis points after recovering quite a bit yesterday. Again, the swing yesterday, the low point was, let me see what we aired. Low point was 99.77. and we ended the day at 99.97. We were 20 basis points off the lows yesterday. That's a big deal. So we ended up ending the day down, what is that, 13.3. So down 16 basis points on the day. Not terrible at all. And recovering about 7 of those basis points now. So, we're creeping things back. That was why on Monday we didn't want to rush to lock. But yesterday, when we got that first initial bump yesterday, that was bad news. I didn't want to continue floating to see that continue to happen. And it could happen again. But, right now, everything's looking the opposite. It is looking like we can at least hold steady. Again, as long as oil prices hold steady, rates will hold steady. That's going to be the big thing. So we'll see where that goes. Anyway, hope that helps, my friends. Ron's got some comments up there in case you want to pay attention. I've got a pounding headache this morning. I'm still getting over this head cold, man. And it keeps coming back, which is weird. So, but anyway, go take a look at those. I have a pounding headache. I'm going to wrap it up for today. Hope you all have a fantastic day. Thank you again for joining me. Tomorrow, we'll take a look and see what's going on with this stuff. We've got one more day before we get to the big BLS jobs report. Tomorrow, we'll kind of talk about what we can expect on Friday with those jobs numbers and how much of an effect we may actually see on mortgage rates and pricing. It may be a lot more than what we were expecting. At the beginning of the week, it looked like that was going to be a non-factor, but it looks like it may factor in a little bit more. But if it comes out like today's ADP report and it shows strength, that would not be good. We wouldn't want to see that. Well, I mean, I don't know that we don't want. That's kind of harsh, right? We do want to see it, but yet it doesn't help rates is the reality. So thank you, Debbie Richardson. Appreciate you as well. Mitchell panic locked in the morning yesterday. Dude, that sucks, man. I'm sorry. Listen, we can only work with the cards we were dealt, and it was not looking good yesterday morning. Again, I put in the text alert to cautiously float and just see, but that was as after we saw that sign of recovery. So, but in the early morning, things were getting worse. So, all right, my friend, I'll chat with you guys later, and thanks, Ron. I appreciate y'all. Take care, everybody. Bye-bye.